So good morning, Brian, and welcome. And let's just start with some of the personal
I appreciate you
stuff.
having me here. Thank you. And thanks everyone for joining us this morning.
Yeah, good. And let's just talk very high level, a little bit about you. Talk a little bit about your job, your background, how you got into it, and a little bit about what your days are like. And then once we get a flavor for that, then we'll kind of jump into some more of the content-rich areas about investing. So go ahead.
Sure. So thank you. So I work as a senior equity research analyst, a sell-side equity research analyst at Oppenheimer. I've been at Oppenheimer for about 13 years. And prior to Oppenheimer, I spent roughly a decade or so at Credit Suisse and UBS doing the same job. So for those of you not familiar with a sell-side equity research, basically, I guess my core function is I follow a group of stocks. So in my case, like the consumer sector, specifically, what we used to call hard lines retail, but that's kind of morphed now into e-commerce and other discretionary areas. So a number of the companies I've covered for a long time have been things like companies like Home Depot and Lowe's, AutoZone, Best Buy. Then more recently, as the consumer landscape has evolved, I have evolved as well, and so has my coverage. So I'm doing more work now in smaller, up-and-coming kind of companies. So names like Carvana in the used car space, Purple Innovation, which is a manufacturer and seller of polymer-based mattresses, Lovesac, which makes and sells high-end modular sofa and beanbag. So it's become a rather eclectic group. And again, so I follow this space and I've evolved with it. So as far as kind of who I serve, Oppenheimer, I guess I'd say my primary customer, my work is money managers who essentially use me and use my firm as a consultant, looking to get smarter on either the space or some of the specific names. And then internally, and this has been particularly the case lately, just given the strength of the overall market, because I work with our investment bankers to, essentially in the capital raising process for companies that either I cover or will cover at some point. So again, that's a very quick overview. But essentially, I'm a sell-side equity research analyst on Wall Street.
Great. And talk a little bit about kind of how you make your assessments, what's the process you go through evaluating companies that as a professional analyst, maybe that's different than somebody that's just kind of done it on their own or whatever.
Yeah. So look, I mean, there's a lot of ways I can answer that question, because there are some very quantitative, methods we take. So, for instance, my associates are on this call as well. So, my team and I, we build financial models, right? So I always use Home Depot as an example because it's one of the even though it's a phenomenally large, phenomenally great company, it's very easy to articulate because the financials are relatively simple. But so we have a financial model. So I mean, essentially, at the core of what we do is we forecast what Home Depot will earn. Home Depot is going to earn the near and in the longer term. So that's it. But then we take into consideration valuation metrics. Like in valuation, we do some very, very stringent valuation work with discounted cash flow, some PE analysis. But there's all the relative valuations. But then also, this is where it gets more touchy-feely. And I think one of the areas I've been able to add value for our clients over time is that I just I know where money's flowing. I'm talking to investors every day. I can tell kind of, I like to say at any moment in time how the market's thinking, what they're looking for, what the market's looking for. So from that standpoint, I can kind of telegraph where I think a stock should move. To this point, last week we upgraded Lowe's, competitor of Home Depot. One of the points we made there is one of the reasons we upgraded it, despite our concerns about the overall macro environment. I could talk about that too, Richard, if you want. But we said, look, we get it. I mean, we're talking to clients every day, and then the market right now is very much looking for cyclical plays, shares of companies that are economically sensitive. And so we look at Lowe's. I followed Lowe's for years. I have a great deal of respect for the new management team there. I still think the company is under earning given its longer term potential. And I think Lowe's is an underappreciated cyclical play within the consumer space. So as part of that upgrade, we very much reflected what our views are, what's happening with the market, where money's flowing. So that's not really, I wouldn't say, a traditional valuation metric, but it's one way we do look at how stocks should perform.
Great. What's your day like?
Market dependent. Again, my associates and I joke about this all the time because we can have a plan in place, but it often does not happen. because we're dependent upon what happens in the market. So I'm up early. A lot of companies, like for instance, Home Depot today reported at 6 a.m. So that's obviously a planned report, but news comes out early, and I'm sure it does for a lot of you on here as well. So we have to react and digest to that. To the extent we're not being whipsawed around by some news or some market event, we write reports. That's really the crux we do. When we say reports, we write some longer pieces. Whether we're pondering upon some company in some significant way or some macro type issue. Then we also write a lot of short comments. A number of our comments are 1 page long. Just talking about some simpler topics. We do that, then talking to clients. Then talking to clients. Now, before COVID, so I've been rather homebound. In fact, I'm in my house right now. I traveled a lot. I traveled. So most of my travel was out visiting our clients and money managers around the world, talking about our insights into the space I cover. Also, I visit the companies I cover. And a lot of times I would travel with management teams of the companies I cover to visit our clients. So hopefully that'll start again. I've been doing a lot of Zooms lately, but I used to be on airplanes.
So like I said, I have some technical questions, which I'm the last person in the world that should be asking. So maybe I'm going to frame it this way. When you're asked questions or what people are interested in, audiences like this, what are some of the high level messages that that they're interested in or that you like to convey to a group like this? A senior level business group that just has general interest in the market, either personally or because it's part of the work that they might do with their clients. Just let's start there and tell me what are some of the major themes that you like to get across so that people are interested in from your perspective.
Yeah, I'll say people ask me that question a lot, and I want to make sure I say this clearly. So, as I said, the core of my role is to articulate, our views on our specific space, our specific covered companies, to people investing in those stocks. So, I think one thing that it's a bit of a challenge is our work is picked up by a lot of different outlets. I see all the time in the media and such that Oppenheimer says this, Brian Nagel says that, blah blah blah, and it makes for great sound bites. Journalists use us a lot because it really helps them to strengthen whatever topic they're writing on. Which again, I think it's great. I definitely benefit. My firm benefits from having my name and my views out there more broadly. But what I caution people is look, our clients that pay us know how to use me. Okay, they know what I know, and they know what I don't know. When you're taking what I'm saying or some views of mine just from a mass market standpoint, that oftentimes gets lost. So I'll make a silly example. When I talk about, I'll go back to my Lowe's example because, like I said last week, my team and I upgraded Lowe's, and this was a very, very, I think well thought out tactical call. And what we were saying with Lowe's is, look, if you're a money manager, okay, if you're a money manager that has to be in the market, okay, if you don't have the option to be in cash. And you're looking, you believe that money is flowing. You want to be with the trend of money flowing to cyclical names. We think Lowe's is relatively attractive for that investor. But the other group we were talking to is hedge funds that have the ability to go short and long, and they were basically saying again, if we think there's a play here, long Lowe's, short Home Depot. Okay, because behind all of this, we're really concerned with the consumer in our group, and what I see happening is that there's a rather significant normalization in spending coming. As the COVID-19 crisis is abating, I think abating at an accelerating rate, I think consumers will get back to spending how they did pre-pandemic. Through 2020, there was a massive shift in spending. I'm sure everyone on this Zoom could attest. We were at home. We were not traveling, not much entertainment. We were eating out. We spent on our homes. We had more time in our hands. We became more focused on home. Companies like Home Depot, Lowe's, and many others benefited significantly from that. Okay, and to their credit, these companies are very well positioned. They capitalized upon a massive upheaval in the environment. But I think there's going to be a give back. So the point I'm making with Lowe's, our call was, it was very nuanced to how to think about Lowe's. What we're not saying is go out and buy Lowe's right now. We're not saying that, but a lot of times, so that's a message. You got to really understand. I speak to a rather specific audience, but our comments get picked up a lot. So I worry about that a lot. And I try to speak as clearly as possible to make sure in case this happens, people don't think, what Brian Nagel is saying, go out and buy Lowe's and put every dollar you have into Lowe's. We're not saying that. We're saying if you have these specific plays in the market, we think Lowe's is attractive. So I hope that answers your question, Rich. I rambled a little bit there. I apologize.
Okay. No, that's good. So, if all of you, I'm sure there are a lot of questions. If you have questions, write them in the chat room, and I'll pick them up there, and then and we'll keep going. But Kevin, we were just in the breakout room, and Kevin had a couple of particularly good questions. So, Kevin, why don't you jump in with Brian? Ask your questions.
Hey, Kevin,
yeah, thank you. Thank you, Richard. Yeah, Brian, just kind of some backdrop. I work for Truist Wealth. My team and I, we manage about $140 million in the practice. And on a daily basis, we're having conversations with clients about the crypto space and how that plays a role into their portfolio. So yeah, I'd be curious. I know our stance on it. I'd be curious to hear your stance on crypto and how it's playing a role in the in clients' portfolios.
Yeah, this is the program. I have absolutely no idea. I'm a big digester, if you will, of financial news. I know, wherever I look at financial news, cryptocurrencies discussed on a daily, if not hourly basis. But as far as like a view or some insight, I don't know. It's just out of my realm. It's out of my realm. I mean, anything I say, so I don't get it. I don't understand what a Bitcoin really is. Clearly it's had a massive move higher, but that's just not an area I have any expertise whatsoever.
Okay.
No, that's fair.
Yeah, and also you had that question about sectors performing that was pretty interesting, Kevin.
Correct. Yeah. So my guys, we're doing a lot of tactical sector investing. Especially coming out of the pandemic here, keeping our pulse on which sectors are going to perform well. We just increased our exposure to the financial sectors. So when we look at financials, we believe that, we've got some good things going on there. Technology, we decreased a little bit. We're still focused on technology, but we did decrease our exposure there a little bit. So what sectors are you guys seeing from an Oppenheimer standpoint that look attractive?
Yeah. So to answer that question, I'll first just I work with a couple strategists at Oppenheimer. So do exactly what you're talking about. It's almost making or advising our clients on sector bets. And I think that what they do right now is particularly valuable given what we've seen these rotations around the market. So this is not my view, but I think they would very much agree with exactly what you're saying, is to reposition monies, for a reopening. Okay. Now, what I would say, this isn't my expertise. This goes back to my comments. I was talking about Home Depot and Lowe's. Look, I've been following stocks for 20 plus years. I have never seen an environment like this. To go all the way back to when the pandemic started, back in March of last year, it was utterly fascinating to me, how quick things shifted. So, here we were, and maybe I'll forget the specific dates. They're called mid-March, when this was declared a pandemic. And the markets were in upheaval. The view at that point, this was when I was talking to our clients in mid-March of 2020 was, oh my God, here we go again. This is the financial crisis all over again. Okay, the markets were going to tank, the economy was going to tank, blah blah blah. Shortly thereafter, again, I think in large part due to very quick, very substantial stimulus on the part of the U.S. government. Again, this is from the consumer standpoint. We saw this resurgence, this surge in spending. So, if I take companies like Home Depot and Lowe's, their stores stayed open. They were deemed essential. They benefited from that. There was initial, there was a kind of a 2, maybe 3 week period where consumers were using those stores to buy cleaning supplies, stock their homes with cleaning supplies, clean from COVID. But then it was right after that. Again, coincident with a lot of the stimulus, but consumers started to spend in some significant way. You saw this massive shift in spending, towards home-related categories and other categories associated with people not going out, not moving, and that trend basically persisted. Look, I'm a big believer in reversion of the mean. Okay, I whatever I've been watching over the years, I think things tend to normalize. I think that's what's going to happen now. So to get to your question, I mean, for my, where I am an expert, and for my expertise is, I think this surge in spending. And I keep on saying home-related categories, but there's a lot of categories associated with people not moving. There's going to be a give back. I think there's going to be a massive give back. I think you're going to have, the spending is going to shift dramatically towards travel, entertainment, dining out, all those types of activities. So from my standpoint, that's how I play that. So what I'm saying is, for my rather limited window into the world, I would be really well positioned here for a significant reopening. And frankly, I think that's what we're starting to see play out right now.
We have several interesting questions. So one from Bill Morrow, almost what you were just talking about. Do you see supply chains like lumber in places like Lowe's normalizing anytime soon, or you're anticipating a return to pre-pandemic pricing? Kind of what you just said, I guess. Yeah.
Yeah, that's good. That's a great question. What I'm seeing, I always put the same caveat there, like it goes back to one of the comments I was making before. I mean, because I have a relatively limited window into the world. Okay, with regard, I'm not a commodity expert by any means, right? But what I'm seeing, I think what happened here with the supply chains, every retailer and every brand I talk to right now is to some extent dealing with either supply chain disruptions on the water, at the ports, or resultant, what looks like a massive uptick in prices. And I think it's kind of all tied together. I tend to think that this is going to be, again, take this for what it's worth, I tend to think this is going to be rather short-lived. And I think it's more a function of having the economy upended and then restarting again so quickly. Okay, now if you look at, I was looking at this morning actually when I was doing with Home Depot, lumber prices are already starting to roll over. Still high, still up significantly from where they were not that long ago, but they're starting to roll over. So I don't think that with this inflation that we're seeing, this massive inflation in certain categories, is going to persist. I think it's more of a blip, if you will.
Okay, good. So just related to that, so maybe just implied, where do you see things going in general, the economy and the market over the next couple of years? And greatest opportunities, greatest risks. Can you speak? I know you're fairly specific. Can you speak in general? Have any thoughts?
Yeah, from the consumer standpoint, look, I think we're right now in this very topsy-turvy environment. Okay, and we keep on the same thing over and over again. I mean, I think there's going to be this give back, from going from stay at home to reopening. After this clears, from what I can tell right now, I think the underlying consumer environment is quite good. So as I look to like 22 and like 2022, 2023, I think, again, keeping all the same, I think we have a relatively healthy consumer backdrop. Now, where I would worry about that would be, where that view could change. We still have somewhat elevated unemployment. We don't know how much of this is going to stick around. So I to the extent that we this economy, we don't get back to pre-pandemic employment levels, that could be a drag on consumer spending. I also worry too, and we started, my team and I have started to do a little work on this. We don't have any great answers yet, but again, all with COVID, there was a lot of disruptions out there. With some of the procedures and policies put in place, people weren't paying the student loans, didn't have to pay the student loans, didn't have to pay rent. What happens when this all starts again? Does that make for a drag on consumer spending? And then look, go back to we're talking about inflation. Look, if I'm wrong, okay, if in fact inflation's actually it is much more persistent. It's going to stay around longer than I think at this point. That could very much be a drag on consumer spending, more from just a crowding out standpoint. As a consumer, if I'm spending more on everything I'm buying, I'm going to ultimately be buying less, right? And so that would worry me. But right now, again, I think once we get past this, what I'm calling this give back phase, which will likely be 2021 and then into 2022, I think the consumer is actually in pretty decent shape here.
Mitch, you had a good question. Why don't you ask it?
Brian, I was going to ask, when you do a evaluation of companies, how do you deal with intangible assets such as brands, intellectual property, know-how, things that aren't easily quantified? How do you incorporate those into your model?
That's a great question. So, look, I'll say with valuation too, and I try to make this point before. Let's see if I can make it to other groups. I don't know if I've done it as well as I could, but I'll try it here. Everything I do, I'm selling to someone, right? I mean, I'm not unlike a money managers who are just, in some cases, not all, some cases working for themselves. I mean, whatever I do, I've got to be able to not only do it, but then articulate. So I try to keep things simple. That's so with valuation, I understand the concepts and workings of a discounted cash flow model. I tend to find discounted cash flow models don't sell well to our clients. So I talk about things more in price to earnings multiples because that just sells much better. Now, as far as what you're talking about, intangible assets, I don't come across that often. I mean, there have been some, like one example, I followed for years before they were bought by LVMH, Tiffany. the luxury brand here in the United States. And we did a lot of work around, especially when the stock was depressed coming out of the financial crisis in 2008, 2010. I mean, how much that Tiffany brand was really worth, the actual value of that brand. And there was a point at which, and again, I'm not going to get the dates exactly right. It's been a little while now, but I'll say, so-called 2010, where the stock or the value of that company we thought was significantly less than the actual value of the brand. And so that was one example where we did that. We made that call, and look, the stock had a massive run after that. I think to a certain extent, in part because the market started to realize that here's a great brand. At that point, been around 150 years. I mean, synonymous with luxury across the globe, and the stock was basically trading below that value. And I think that's one of the reasons the stock really took off from there. So that's one area we've done it. In other cases, I've had companies that have again, for most retailers are asset light. Most are, but there are cases where for one reason or another they own assets. I'll use Home Depot as an example. And others, Home Depot actually owns a large chunk of stores. So going back to financial crisis there too. I mean, that's not necessarily an intangible asset, but I think it's an overlooked asset. If you look at the actual underlying value of the real estate portfolio that Home Depot had acquired, there was a point at which the stock was largely trading below that. So I guess really to answer your question, it's something we've looked at. I tend to view it in more distressed situations. With these assets, either a brand or some type of asset that's not really well recognized in the market, could lend support to a stock price.
Mm-hmm. Thank you.
Yeah. Hey, Bob Zecca, if you're there, you had sent me a couple of really pertinent questions. Maybe after hearing Brian talk to you, any of those that you'd like to sort of refine based on his discussions, or I can ask them, but if you've got them, you could ask them.
I don't have them in front of me, Richard.
Okay. All right. Well, I'll ask them because it's sort of what e-commerce has forced many brick and mortars to close. Do you ever see them making a comeback? And if not, how will these big malls be sustainable in the future?
Yeah. So look, I'll answer it this way. Retail stores have evolved. They're evolving, it's probably said better. This has been happening for a while. I very much think that there will remain a place for retail stores in the consumer landscape. Okay, but we've already seen this start to play out. And I think it continues. No doubt there will be fewer stores. There's going to be fewer stores. And so these lower quality malls, malls that basically historically housed potentially lower quality retailers. I just don't see a way out for them. I really don't. And again, we've seen this play out already, but I just don't. I don't see a way out. Now, I think on the other side, though, the really high quality malls. Now, there's my colleagues and friends that do work in the REIT space. They always talk. I think there's maybe 100 or so, 100 really high quality malls across the country. They continue to thrive, and frankly, they're thriving more. But that's a very, very small subset. Most of the retailers I cover or watch closely are more likely to close stores than open stores. I mean, we've got a few that are open stores, but they're most likely to close. So I think there will continue to be a dearth, if you or an abundance of available retail space available. So it's good to look at. What's all behind this is, and this has been the trend for the last 20 years. I mean, more people are shopping for more products online. Retail stores have largely become showrooms, to enable online shopping. You just don't need as many stores.
Bob, you had some great questions. I'm looking at them because they're very relevant to this, so I'll just keep going. So did the government stimulus checks impact the retail consumer market, or was it mainly for survival payments of rent and food? So what was the impact of the government stimulus checks, basically?
Look, that's a great question. And I mean, I'm going to make sure I answer this really well. I have been blown away, literally. As an analyst following the consumer space, okay? And I'm looking at, obviously, results from our companies, commentary from our companies, and then, any type of other more macro data out there. I have been utterly blown away this last, say, several weeks, to the extent to which government stimulus drove discretionary spending. And it's across the board. I'm trying to think of the number I can give you. I was trying to mix up, not just talk about Home Depot, but that's since it was only 2 hours ago, so fresh in my mind. I'm just keep on using that example. But look at like Home Depot here in the first quarter, the fiscal first quarter of 21. So that's the quarter ended April. Their comp store sales, which are sales basically at existing stores, domestically were up roughly 30%. That for Home Depot, that's a massive number. It's almost it's hard for me to even comprehend that number. 30%. Because I would say in a normal good year, Home Depot sales, good year, Home Depot sales have been 5. Okay, 30. So here in the fiscal Q1, they're 30%. What makes that, and to help with this point about stimulus, if you go back to the fourth quarter, so that was the period ended January. I forget the exact number, but comp store sales were up 20 to 25%. So when I think about that, that shift, that's largely a function of stimulus. And that's Home Depot's business. Again, across the board. I mean, it's amazing how much the stimulus drove discretionary spending.
Steve Rosen, good question. Why don't you ask it?
Yeah, I think it ties into what we've been talking about. But I guess my question is, given what's happened over the last year plus, have the buying habits of people changed permanently? And can a company that doesn't have an omni-channel strategy be successful?
Yeah, that's like a $64,000 question. That's a great one. So when people ask me, in my view, if buying habits have changed permanently, I say yes and no. Okay, so I tend to think from a category, and this is what I was talking before, from a category standpoint. I don't think they'll change dramatically. I think there's some people, some of my competitors out there, some people who disagree with me are arguing that there's been a permanent shift to home-related spending. Okay, I disagree. I disagree. In fact, I think it's just a matter of as people get going again, moving, what this outside spend in the home that occurred through 2020 and then into 21 will give way to spending on travel, entertainment, that type of thing. In fact, and I also make the argument at that point, what concerns me even more is that there could have been a significant pull forward in demand into the home. So at least a portion of this spending that happened in the home in 2020, came at the expense of what would have happened in 21, 22, and even 23. Okay. Now, as far as the other side, though, and I think this is more the question you're asking, on the online, look, yeah, I think there's been this trend for 20 years now, roughly 20 years old. Of stronger and stronger online sales. And been growing. Okay, but I think what happened through the pandemic is that basically accelerates. So what occurred then in called a year, was what normally would have occurred in probably 5 to 7 years. Okay, I do think that sticks. And I think consumers, a larger portion of consumers were just basically forced into online spending, and now they realize the conveniences of it, and they'll stick with it. So to get to your second question, look, I mean, there are certain categories, like home improvement, like auto parts, and others that are, lend better to stores. The service in the stores, the touchy feeling of to see what this product is, the kind of the need it now type thing. Okay, but those are unique. I tend to think that more and more shopping is going to happen online. Maybe in conjunction with stores, and that's where the whole omni-channel model comes up. But I think more and more shopping is going to happen online, and I think that sticks. So, generally speaking, retailers and brands that don't have some type of online presence, some type of omni-channel infrastructure, I think are suffering, and I think they're going to suffer even more. And I think those can become huge market share opportunities if they haven't already. Huge market share opportunities for these more digitally enabled companies. Absolutely.
Jerry Hampton, it's kind of related to this. You want to ask your question?
Sure. Yeah, Brian, thank you. Can you discuss some of the new companies you're following? You mentioned Carvana and Purple Mattress. How do they get on their radar, and what do you see for some of their future? Will they continue to grow, or will they be acquired by some of the existing, companies that are out there?
Yeah. So what's happened, it's very, very interesting. This ties into the prior question, just with regard to to online and omni-channel. I think that this massive shift, and this is before COVID. I mean, again, accelerated through COVID, before COVID. This massive shift to online and omni-channel really allowed for these upstarts to kind of to break into these spaces quicker than they normally would have, and then and flourish much quicker than they normally would have as well. So you take that's like a Carvana, I think is a phenomenal example of it. So for those of you not familiar, Carvana is an online only seller of used cars. Okay, I think the business has been around now for somewhere 7 years or something like that. But I mean, it's a relatively new company. I've followed for years now CarMax. Okay, so CarMax was basically incubated and spun out of Circuit City, which is no longer with us. CarMax has been around roughly 25 years or so. And so CarMax is the used car superstore. Okay, but I think this, I can make this little point I'll make. I can make sectors across the space. But what happened here is, CarMax is a great company. CarMax was the disruptor in the used car space. CarMax has been grabbing market share in used cars for 20-something years, right? But with Carvana, the digitally enabled online model really was able to, given shifting consumer preferences, given the availability of digital technologies, Carvana was able to break into this space, and really upend the space. And what I find really interesting about this is I watch these companies closely. Is that here CarMax is the legacy player, still growing, great company, but they really had to learn a lot, from a distance, learn a lot from Carvana, because Carvana came in with a blank sheet of paper. They much more of a digitally minded management team, tech-enabled management team, and they I think Carvana looked at CarMax and said, okay, look, how can we do this better digitally? And then CarMax is, subsequently been looking at Carvana and say, like, look, they're younger than us, they're smaller than us, but they do some things really, really well. And so you've had this, the two companies have grown together. But that's what I see happen. I just think this proliferation of digital has allowed these companies and these brands to break into categories. And so I use Carvana as an example, but that's exactly what we see. I mean, Lovesac. Again, if you're familiar with Lovesac, so basically the company has two products right now: the Sac, which is a high-end beanbag, and then the Sactional, which is a high-end modular sofa. And if you haven't seen these products, they're phenomenal. You should check them out. But so there they are. I mean, so they're breaking into the home furnishing space. Now, granted, they're doing it with a unique patent protected product, but also this digital mindset. So right now, Lovesac has roughly 100 showrooms. There's stores across the country. They're small, a couple thousand. I mean, I don't even think it's a couple thousand square feet, but the stores are designed just to showcase the product. All the transactions happen online. Very well built out website. So digital capabilities, but they're selling these products, these unique products, largely online, and that's really upending the home furnishing space. That's the same. The Purple innovation. It's a very, very similar to Lovesac. So Purple has this. It's a polymer-based premium mattress. Okay, so again, unique product, because basically Purple is selling this polymer, which is like a rubber polymer-based mattress against all the different foam out there, but they're doing it with this omni-channel infrastructure. And in the case of Purple, they use more wholesale relationships. But that's what I'm saying. That again, I do a little in the fashion space, not much, but I think this is even truer in the fashion space. You've seen these brands come to market much quicker. Historically, a brand would have had to basically fight their way into the department store, fight their way into some other type of retailer. Take a long time. May have never happened. But now, with their the digital tools at their disposal, they're able to get to consumers much quicker. They're able to and really bypass that whole process of having to fight their way into these retailers. So I hope that answers your question. But again, I think this has been a massive shift in consumer.
Great. Noel, you had a bit of a technical question. Was interesting. Could you ask it? You'll ask it probably better than I would.
Sure, thanks. Brian, I think you've already touched on some of this, but I was just curious how you go about using and sourcing information relative to macroeconomic trends in your models. Do you rely primarily on centralized or third-party macroeconomic forecasting, or are you doing some of your own within your group?
Yeah, so it's a good question. So, I mean, that's one of all of me and I'd say my competitors out there, the guys have a similar type of job at other Wall Street firms. We kind of all have our little things that make us unique. So I pride myself on, kind of having an understanding. I wish I'm not an economist, right? But I think I have a better understanding of most of the kind of macro variables and how that fits into, the specific ongoing, the workings of our company. So we do that a lot. And my team and I write a lot on, kind of what we're seeing in spending broadly, and then what that should mean for individual companies. Okay. Now, I don't do much in the way of forecasting. I mean, they're all rely on either forecasts that come out of strategists at Oppenheimer. But what I talk more about is historic relationships. So again, you can kind of say there may be some forecast that comes out of this, but I'll say, look, this is what we're seeing right now. Again, this goes back to the theme I keep talking about is with this shift, what I think is going to be a normalization in spending. So if I look at what I'm thinking is happening right now, where have we seen this historically? What was the outcome, right? I do this a lot with like interest rate. Even though interest rates have been on a pretty significant decline for a while, but what would happen if interest rates were to rise? And what impact, if any, does that have on the consumer? We've done some work around like inflation. Lumber prices. I think I mentioned just a few minutes ago. Again, what happens if lumber prices continue to do this or whatever? Historically, how has that affected? How has that affected consumer spending or spending of these companies? So I don't make forecasts. Because I'm really careful, especially for the sake of our clients. I don't want to overstep my bounds of expertise. But I can say with authority is historically things have done this, and this is probably where we're headed into. We do some scenario analysis. Say again, just using history as a guide. This is what we saw historically. So if we say, okay, these are the 3 different potential outcomes what could happen, what would history say should happen? But if yeah, so that's the point. And I tell my associates this all the time. Look, if I started coming out saying, look, I expect GDP to be here, my clients would say, this guy has no business talking about that. So I lose credibility. I don't know how to forecast GDP. I don't know how to forecast unemployment, but I can see what it's done historically.
Good, thanks.
Brian, what issues might keep you up at night? What worries you? Is it, you alluded to what if I'm wrong about inflation or whatever, but are there other things that you would say that you always are thinking about that I don't know, worry you, may not be the right word, but preoccupy or whatever in your work?
No, look, that's a great question, Richard. So I mean, one thing, it's a fun mental exercise, but it's also exhausting too. Is what are we not thinking about? What comes out of left field? Like I mentioned, I forget exactly what question, but I think I said something effective. My team and I are starting to look at this issue of consumers having to start to pay rent. Again, starting to pay back on student loans. I don't think people are talking about this enough. It's very, very difficult to size this. But to say, okay, to what extent was consumer spending bolstered over the last few quarters, because people weren't paying student loans. So what happens? Then what happens when those student loan payments start again? Again, you can tell this is the way I'm talking about. This is not something I'm terribly familiar with yet. But what worries me is a lot. So what worries me is that when I see an issue that no one's talking about yet, no one's really thinking about, because that's usually where that's usually where things get sidelined. I mean, if everyone's talking about, we can figure it out. We can figure what people are talking about. So we go through that mental exercise. So what are we not saying? What are we not saying? We don't want to make sure we don't get too complacent. Again, that's where that's why I can add a lot of value for our clients, right? Because Wall Street, as other businesses, are extraordinarily susceptible to groupthink. People get comfortable, right? Because everyone else is saying this, everyone else is saying that. But okay, so it's really part of our job to think what are we not thinking about?
So my last question, and then we'll see if anybody else has any, is maybe again this is a fair question or not. What advice do you have for the average investor?
Well, play the long game. Honestly, I mean, I do. I was telling you, Richard. For my undergrad, I do a class. I do a class like this for every year, and I ask, I say, look, I've been around Wall Street now for a long time. Okay, there's some, there are extraordinarily smart people on Wall Street. Very, very good investors. But if there's one real limitation, I've seen this over the tenure of my career, is the investment window is shorter and shorter and shorter. So these what people call long-term investors now. I mean, that used to be 3 to 5 years, right? I mean, honestly, long-term now 6 to 9 months. Okay, so I think one of the biggest ways that an individual investor can sort of say, take advantage of a flaw or on Wall Street is just invest for longer term. So really, do think about where things are going, where a business are going over some length of time, and then you can beat Wall Street on that basis.
Great, thank you. All right, Jim Thompson, we have a few more questions popped up. Jim, ask your question.
Yeah, actually, I wasn't really posting a question. The thing about brick and mortar is not so clear that it's just going away. In fact, I posted a link that talks about 14 retailers nationally who are adding thousands of stores in 2021. So, and there's really two areas of focus for those value retailers like dollar stores, Five Below, but even Target are adding stores significantly. And then beauty retailers, and Brian may have touched on this, but as part of the changing consumer trends, people are going back to fashion and beauty. And Sephora and Ulta are adding combined hundreds and hundreds of stores on their own, as well as opening Ulta outlets in Target and Sephora outlets in Kohl's. So there are sectors, brick and mortar sectors, that will grow significantly because all of us are very different. And so there are sectors that respond to consumer behavior evolving over time.
That's a great point. I obviously can't see the article right here, but I totally agree. And I totally, there are, what's happening, so within the group that my team and I cover, we have names that are still opening stores. I mean, one example is like a Five Below, which is, that's kind of on the discount side, which you mentioned. Yeah. So Five Below is a great stores-based business, very difficult to replicate online. The consumers go to that store, their core customer, if you will, the way their core customer shops in stores, it's usually someone, it's either someone young, teenager, or a parent bringing their kids there. And there's a treasure hunt type experience. There's the merchandising is very eclectic, very, very good. When people go there, they want to spend $20, $25 and buy some stuff. That's very, very difficult to replicate online. And Five Below also does a good job of kind of leveraging off of traffic brought on by other retailers like a Walmart or a Target, in some cases like a Home Depot, whatever. But so the big benefit for right now for Five Below, and I think this is exactly the point you're making in your article, is that given that so many other retailers that historically grown or not growing now, or in some cases contracting, they're getting much better rent deals. So what Five Below says is that not only they're getting better rent deals on stores that they normally were going to, but they're actually now they're getting into retail locations that historically were not available to them. So better locations with these landlords or property owners are really clamoring for a company like Five Below that's growing and drives traffic. So I totally agree. I mean, there's the idea, and in fact, I was doing a presentation this about a year ago, like the idea that the retail store is dead is completely wrong. It's not dead, it's changing. But I do think at the end of the day that there's gonna be fewer retail stores out there. There's gonna be fewer retail stores.
Charlie, you have your hand up.
Thanks, Richard. Brian, so CEOs seem like they are increasingly willing to take political stands, which can be polarizing. Do you see that as a trend that's going to stay or drop off? And without naming names, do you have companies already in the portfolio that you're managing where people will say to you, don't bring me that name because I associate them with this cause or this thing that I'm on the opposite side of?
Wow.
Yes, let me unpack that a bit. I am definitely seeing a trend. I mean, just like exactly what you said, where companies feel either empowered to or need to, take stance. Okay, and I think there's numerous examples within my coverage, but I think probably the best one's Nike. Nike. So we've seen with Nike over the past couple 3 years now. So really taking stands on social issues here in the United States, and then more recently in China. And it's very, very interesting. I mean, Nike, I mean, my personal view, I think Nike is a phenomenal manufacturer of products. I mean, they create some of the best athletic product in the world, right? They have for years. But I also think they are an incredible marketing machine. And I don't want to go into all the details here, but kind of the stances they've taken. But I know when they with you in the United States or more recently in China, they says, by doing this, they're going to distance themselves from some segment of the population. Okay, and I think what Nike has done very, very well, and I give them a lot of credit for, is yeah, that's true. But they know their customers so well, that whatever segment of the population they are potentially distancing themselves from, there's a much larger segment of the population that they're getting much closer to by taking this stance. And essentially strengthening their brand with what is more of their core customer. Okay, and I think this is just speaks to how strong Nike is as a marketing machine. And I think this is very much a trend. I think it's going to continue. I think Nike's done it very well, and inevitably there's going to be companies that try to do this and they don't do it as well, and it hurts them. I haven't necessarily seen that yet, but it's inevitable. As far as your, I haven't seen that yet. Okay, I mean, I haven't seen or heard an investor coming and saying, "Look, I'm no longer investing in this company because of the stance they've taken." There are other. This is going back a ways, but I mean, there were a number of investors that I dealt with over the years that wouldn't invest in, tobacco companies. We're starting to hear. And this goes a little bit off your question, but I think it's worth making the point. There's more and more investors kind of looking for, companies that are much more environmentally friendly. So they're building portfolios around that. So if a company for one reason or another is not environmentally friendly, they won't invest in the stock. Then the other thing, cannabis. I haven't mentioned the word cannabis yet once, because that's been a much more of a bigger. I mean, cannabis is one of the fastest growing areas of consumer. So we cover a company by the name of Grow Generation, which I like to say is the Home Depot of the cannabis industry. It looks a lot like Home Depot did 25 years ago. It's just that there's a small, rapidly growing, I think very well run retailer that serves the rapidly growing cannabis industry in the United States. Great story. I think the stock's got tons of room to run. But I talk to a number of investors right now that simply say, look, I can't invest in this because even though they're not producing cannabis, they're not making cannabis, the fact that they already play on cannabis, my fund won't let me invest in it. Now, in that case, I think that's an opportunity, because I think it's only a matter of time. With cannabis, I think these rules will be over time relaxed, and I think you're going to have a much bigger potential group of potential buyers for a stock like Grow Generation. That's one area where I see investors kind of sitting on the sidelines right now.
So you bring up. Sorry, Richard.
No, go ahead, Charlie.
I was going to say, you bring up an interesting point, which I had never considered, and that is, so it's your feeling that before a CEO would even speak up, they've done their homework in terms of social media by figuring out, all right, I may alienate this group, but I will endear myself to this group even more, and the numbers work. And I hadn't even considered, considered that part of it.
Yeah, I sure hope so. I mean, look, I think that is the case with Nike. Again, I just have a ton of respect for Nike as a marketing company, right? So they have not said that specifically to me, okay, nor would I expect them to. But I just, knowing them as I know them and watching them over the years, I think that's, I almost certain they're having that discussion, okay? But like I said, I think it's inevitable. You're going to have a company out there that does not go through that exercise, takes a stand, and it ends up hurting them. I can't think of an example. Yeah, within my coverage, I cannot think of an example right offhand of that happening yet. Where I've seen, I tend to follow higher quality companies, so maybe that's the reason. But it's inevitable. It's going to happen.
Great. We're coming towards the end, but time for a few more. So Jay, Halbert, you have a little bit more of a technical question or interesting question?
Yeah. So Brian, do you have some type of a discipline process where every week or month or quarter you're looking back at what you had projected, what you had recommended, and then seeing how it turned out so that you can kind of refine your process going forward?
I do that. It's probably not as disciplined as it should be. My associates have heard me say, it's like I have two relatively new associates in my team right now. They're and I take a lot of pride. And the pitch I give them when they join me is, look, I like to train people, and so and I've trained a number of associates over the years. So they'll hear me say a lot is, when we're deciding what to do or how to think about something, I'll say, look, I've seen this before. I either did really well with this or I really screwed this up royally. Okay, so I do have in the back of my head where I've been right and wrong, and I tried not to make the same mistakes again, even though it's not always happened. But it's probably not as my process is probably not as disciplined as it should be. It's just more in the back of my brain where I've made mistakes. I mean, like a silly example of that. I mean, there's different events will cause me to kind of the caution flags come up, right? Okay, so one thing I say this a lot: when a CFO leaves, now again, CFOs leave. I mean, CFOs go on to higher paying jobs. They go into CEO roles. There's all kinds of reasons CFOs leave, right? But when I have a CFO leave, that always sends up a cautionary flag, because more often than not, or not, I said that probably too strongly. A lot of times, I've seen a CFO leave, all the greatest excuse in the world, makes perfect sense, right? But then it's only a matter of 2-3 quarters down the road, the wheels start coming off. And what I basically say is, the CFOs, they know the financials of this business better than anyone else in our organization. They can see that. So that's one. I mean, that's one example of a lesson I've learned the hard way many times. I've kind of taken that, going forward, how I think about these names. Another simple, relatively simple too, is when a company, for one reason or another, shops itself aggressively to private equity, to go private type organizations, right? And for whatever reason, that process doesn't lead to a transaction. Okay. Then I'm also extraordinarily cautious. I'll be cautious for a while, because in my relatively simple view, those very smart investors got a great look at this business. They all passed. Okay, they've probably seen something I don't have the ability to see, just because I don't have as great data at my disposal. And then inevitably something else comes down the road.
Great. Okay, so I think we can wrap it up. This has been a really rich discussion. So you want to put it back to the full screen? So a couple of thank yous. First of all, Brian, thank you so much just for taking the time, but also thank you to the group for really, I know this is always a really sharp group, but when just hearing these questions today just made it all the richer. So just a really terrific hour. And with that, I'll turn it over to Mona to sort of wind things down.
Thanks, Richard. Brian, thanks again for
a
really interesting session.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.